So buying a multiple unit property and then living in one side of it and renting out the rest, that's that house hacking thing that you're hearing everybody talk about. Now, there are different ways of house hacking. Some people are renting out bedrooms. I'm going to show you how to do it so that you can get other people to help you pay your mortgage payment. And so that's what we're going to talk about today. Now, we're going to start. So there are 5 different agencies, we'll call it. And every agency is the type of loan. So it's FHA, Fannie Mae, Freddie Mac, conventional, VA, USDA, and every single one of those will allow you to purchase 2 to 4 unit properties. So a 2 to 4 unit property will allow you to buy a home to live in it and rent out the other units for additional income. So again, this house hacking strategy is really popular right now, and it's really, really smart when you have higher interest rates. Because if you think about this, if you have somebody else paying half your mortgage, then your interest rate is really about half of what it says on the documents, right? Because your actual mortgage payment, your out of pocket, is significantly less than what your actual payment is. So this is a huge, huge advantage. And this is a very, very smart strategy. So there are differences. So what we're going to cover in all of these, and the big difference between every single program, there are different loan types that you can use. You can use adjustable rate mortgages or fixed rate mortgages, 30-year fixed mortgages, 15-year mortgages. So there's all different types of loan types. And so that's why we're breaking this down. Today, we're only going to focus on FHA. In other episodes, and you can find those on the channel here, you'll find Fannie Mae conventional, Freddie Mac conventional, VA for veterans, and USDA rural development loan. We're going to discuss the different loan to value or down payment. What's the minimum down payment to buy one of these kind of houses? There's different credit score requirements for every program, and non-occupant co-borrower. So that means is somebody lending you the money to help you buy the house, or to help you qualify for the house, not lending you the money for the down payment, but lending you the money to help you qualify. So a co-borrower, they're contributing their credit score, their income, and their expenses to help you qualify for the property. That's called but they're not going to live in the property. That's called a non-occupant co-borrower. And that's important because that could be parents, a rich uncle, grandparents, something like that are going to help you qualify, get you into your first home, but they're not going to live in the home with you. So there's different guidelines around that. We're going to cover that. Reserve requirements, right? So is it different if I buy a single family house that only I'm going to live in and I can't rent it out? Do I need to have more money in the bank to buy a 2 to 4 unit property? And the answer is yes, in some cases. And that's why we're breaking this down by agency so that you can determine which particular program is going to fit kind of into where your qualifying criteria is. Then ADU, this is another thing. This is a detached accessory dwelling unit. So that's like a little house in the backyard or a pool house or something like that. And again, that's a big house hacking strategy when you have ADUs. I'm kind of an old guy. We used to call them granny units because grandma would live in the backyard in the granny unit and the rest of the family lived in the house. So you could still take care of your grandparents, but they didn't have to be under your roof with you all the time. So there are different rules about whether the duplexes have to be attached to each other or whether it's a separate little unit that's still on the property and is detached. And then here's the big one. Can you use rents to qualify? And the answer in all cases is yes. If you are buying an owner-occupied property and you rent out one side, you can use some of the rents that you're receiving to help you qualify for this 2 to 4 unit property. So we're going to talk about exactly what that is. So let's look at the FHA loan types that are available. So you can buy a 2 to 4 unit property using a standard FHA loan. So the standard FHA loan is called a 203B. That's the designation given to it in the guidelines for it, in the HUD guidelines, or a 203K. 203Ks are commonly known as rehab loans, and that's a type of loan that you have the ability to buy the property that has repairs on it, but you're buying the property based on the value of what the property will be worth after you do the repairs. So it actually gives you the ability to borrow the money with the purchase loan to do the repairs, and then the loan amount is based off of what the property will be worth after you do the repair. So that's the 203K. A reverse or home equity conversion mortgage. This is a special program available by HUD for people that are 62 years and older and have equity in their home. So if you're purchasing on a reverse or a HECM, home equity conversion mortgage, you can use 2 to 4. You can buy a 2 to 4 unit property. You can also use it for energy efficient mortgages, which are special mortgages that qualify. Actually, I believe the energy efficient mortgages is a sort of a add-on mortgage that you get at a discounted rate to help you upgrade the property to make it more energy efficient. So basically all of FHA's programs, you can buy 2 to 4 unit property with any of their loan programs. So the maximum loan to value. So the loan to value is how much you're borrowing compared to what the property is worth. So 96.5% on a purchase, 90% on a purchase if it's under a 580 credit score, and 85% if you have an identity of interest. So that means if you're buying the property from a family member or a business partnership, you can only go up to 85%. Now, there are actually ways around this. And I think I'll get into it. If I don't, I will try to touch on it. If not, it's probably a good other video. So what that really means, loan to value, let's translate that into down payment. So FHA mortgages are 3.5% down payment. This is amazing because what you're going to find is with the other loan programs, it is not a 3.5% down payment for a 4-unit fourplex. It's much higher down payment for a conventional mortgage. So you can put 3.5% down. Now, if your credit score is below 580, you have to put 10% down. And if you're buying this property from a family member or a business partnership, then you have to put 15% down. Now, I don't think I talk about this, but there's a hack for that. So if your family member, if you have a family member that owns the property and you move into the property and you live in the property, you can pay rent on that property for I believe 6 months. And I believe your family members can even add you to title. You're not on the loan, but you're on title. And then you can bypass that. And it would actually be a refinance at that point. So I'm actually not I haven't looked up that guideline in a while. So, and that was just kind of a little impromptu. So definitely talk to your loan officer if you're going to be buying multiple family houses from a family member or business partner to avoid that 15% down payment. I know there are ways around it. I've done it, but it's been a few years. So the minimum credit score is 580 if you want the minimum down payment. So if you have a 580 credit score, you can put 3.5% down and you can buy a duplex, a triplex, or a 4-unit property with an FHA loan. Non-occupant co-borrowers, so if you have a non-occupying, so if you have a co-borrower that's helping you qualify for the loan, so they're going on the loan application, this isn't the same as giving you gift funds for down payment or closing costs. This is they're going on the loan application. They're giving their social security number, their income, their assets, their debt. It is permitted, but the loan to value is going to be 75%. So that's going to be 25% regardless of religion relationship. Okay. So if you have a parent or a grandparent or a relative, an approved co-borrower through FHA, if they're going to help you with the loan, you're going to have to put 25% down. Reserve requirement. So AUS stands for Automated Underwriting System, and all lenders everywhere are going to use this automated underwriting system. Now, FHA, there is a manual underwriting option, which means that if you can't get it through the automated underwriting engine for some reason, an underwriter can actually look at it and manually underwrite it. That comes with a lot more strict restrictions and a lot more limitations. But basically, if you can get an automated approval and you're buying a 1 or 2 unit property, like up to a duplex, there are no reserves required. Now, reserves are typically measured in months of principal, interest, taxes, and insurance. So whatever your principal, interest, taxes, and insurance payment is on this loan, that is what they're saying as far as reserves. So if you look at 3 to 4 units, 3 months principal, interest, taxes, insurance, PITI. 3 months PITI is required. So whatever the payment is going to be, you need 3 months worth of payments in an account that you have access to. That you can pull the money from. So if it's in something that's locked, like Social Security, there are certain retirement funds that you cannot get access to it. That's not going to count as reserves. So reserve guidelines are actually, you know what, that should probably be another video series because reserves can get interesting. But the reserve guidelines for FHA is going to be 3 months if you're doing 3 to 4 units. Additional dwelling unit. So an ADU on an FHA loan is considered a unit. So if you have let's say you have a duplex, so you have the house you're going to live in, and then the other side is connected to it, like a duplex, right? So it's connected, you share a wall. Then there's another small building on the property that, it may only be 600, 700, 800 square feet, something like that, maybe 500 square feet, but it's got a kitchen and it qualifies as a living quarters. And living quarters is another thing that is going to be determined by the appraiser, and it has to meet guidelines. So it has to meet guidelines in order to rent it out or in order to have it be considered a unit. But if you have that, so 2 units, you share a wall, and then you've got a small unit, then it's going to be considered a 3-unit property, and you're going to be subject to 3-unit guidelines. And the 3-unit guidelines are different than if you're doing a 2-unit property, and we'll go over that in a second. Can you use the rents to qualify? You can use a percentage of the rents from non-owner occupied units as income for your debt to income ratio. Now, typically this number is 75%. So 75% of whatever the rents are. Now, this gets in the weeds a little bit, but it's worth mentioning. If you buy a duplex and somebody's already renting the other side and they already have a lease, then the underwriter is going to use the current lease amount. If you have to honor that lease, in most cases you do, you have to let them continue to live in there. Just because the landlord sells the property, if they have an enforceable lease to live in that property, that transfers with the sale, and they are allowed to continue to live in the property. Just because the owner is selling the property, it does not nullify or cancel out the lease. So that's one way that you're going to get what that dollar amount is. The other way is if it's vacant, if there is nothing in there, the appraiser has the ability to do a fair market rent survey, and they're going to determine what that unit would rent for in today's market. Now, if you haven't already kind of figured it out, a fair market rent survey is probably going to be higher than the existing lease that the family that lives in there already has, because typically leases are long-term. If they've had the lease for a while, market rates may be different from when they sign the lease. And right now, with the lack of inventory, the lack of homes available for sale, the rents are going up because it's harder to get housing. People can't buy, and so there's a bigger demand for rentals because there's not a lot of houses to buy, and with the interest rates what they are, there's just a lot of people that are choosing not to buy in this market. If you're watching this video, you're one of the smart ones. You 100% should buy in this market regardless of interest rate. If you're younger, you might think this is a high interest rate. For me, this is not a high interest rate. I've seen this interest rate several times in my career, and I've seen way, way higher than this interest rate also in my career. So you absolutely want to get into this opportunity, especially when you're buying a 2 or 3 or 4 unit property, because your renters are helping to pay your rent. So maybe it's not a 7% rate because somebody's paying half your mortgage. Now you're looking at about a 3.5% rate. And now we're right back to where the interest rates were the lowest that they've ever been. Okay, now this is unique with FHA for 3 and 4 units. So if you have a 3 or 4 unit property, there's actually a calculation. It's called a self-sufficiency test. And what they're going to do is the underwriter is going to say that 75% of the rents from the non-owner occupied units must equal or exceed the principal, interest, taxes, and insurance payment on the mortgage. All right, let me say that a different way. The rents that you receive from the units you don't live in, the total of those rents have to be bigger than your mortgage payment. Okay, that's a self-sufficiency test. There are some markets that doesn't work in. There are some markets that it works in great, but it's something you need to be aware of. If you're buying a 2-unit property, it absolutely doesn't matter. You're just going to take 75% of the rents from the side that you don't live in, and you're going to be able to use that to not only help you qualify for the mortgage, but then those rents are also going to contribute to making your mortgage payment. So 3 to 4 unit self-sufficiency test. This is very important. The rent collected from the units that you don't live in total have to be greater than the mortgage payment on the loan that you're taking out to buy the units in the first place. So that's unique to FHA. So as you can see, there's a lot of nuances to this. There's a lot of ins and outs. The reason I do these videos is because almost every single one of you, if you went online and if you do a Google search, you're probably going to get caught in a call center. You're probably going to end up with some kind of push button, get mortgage company, and you're going to find out that the kid who's working in the call center has been in the industry for about 6 months and knows nothing about mortgages. He's reading off of a script on a computer. Unfortunately, that's where 98% of all people end up on their first shot. If you did that, you probably came back online, you probably typed in a little bit more detail, and hopefully you found my video. It's important that you work with an experienced mortgage professional because they're not just going to give you answers. They're going to reference the guidelines. They're going to research your options, and they're going to lay out all your options. If you don't qualify for a Fannie Mae loan to buy your 3-unit property or your 2-unit property, they're going to know to recommend an FHA loan to you because they know you will meet those qualifications. So I absolutely implore you, the reason why I'm doing this and the reason why we created findmywayhome.com is to help empower you and educate you and help connect you with mortgage professionals that have been doing this forever, that love looking up guidelines, and they don't like to say no for an answer. So if you have questions about buying units, buying a 2 to 4 unit property using an FHA loan or any other loan, you can find an entire network of mortgage professionals at findmywayhome.com. And you have the ability, you can either go in there and you can search by state and find an expert near you. They have videos up there. You can watch their videos. You can get to know, like, and trust them before you reach out to them. Or you can trust me and I'll introduce you to somebody. There's an easy way for you to put in your question that you have about qualifying for a mortgage, and I'll match you up with the best person to be able to help you. So I hope this is helpful, and be sure to follow the next couple of weeks. We're going to follow. We're going to do Fannie Mae conventional. We're going to do Freddie Mac conventional. We're going to do VA loans for veterans, and we're going to do USDA loans and how to house hack using those programs. So I hope this is helpful. And if you're in the market right now, congratulations, you're doing the right thing. And we're going to see you next time.